The Bulls versus the Bears. Get in the game. www.tackletrading.com.
Hello everybody, this is Coach D with TackleTrading.com, here to give you a market update, quick video recap. Interesting day. Yesterday I posted a handful of posts and videos about if the bulls are ready to run, how we could profit from it, and I'll tell you what, the bulls disappointed. If you go back and watch those videos and you pay close attention, you'll notice that I consistently talk about confirmation, making sure we trade up, looking for confirmation on the breakout, and use little words like assuming the S&P is running. And I believe I even went in and talked about like intraday, what we would need to see for confirmation would be a violation of the W pattern, and it just didn't pan out. The market in fact ended up giving way to the bearish downward trend pressure here on the SPY, the spider, and this was the W I was talking about, and said, you know what, for real confirmation we have to trade above that pivot point. And despite yesterday's really strong bullish activity and run, the high volume in reaction to the Fed's meeting minutes, really the bulls did not really have the horns, and we see the bears raring, and we now see the S&P down here in a pressure zone, pressuring that support zone. Now we have to watch that for potential breakdowns. And as we look at this across the market, what I'm seeing in this, let me go ahead and look at the futures real quick, ES space pound sign and the letter F. And one of the reasons I like to look at those futures has a lot to do with what the professional big boys trade. And the index itself is not traded. Options are traded on it, but the index itself is literally just the average of the stocks. And so the futures give me some inkling of what the professionals are doing, and the exchange traded funds show me some trading psychology, whereas the index, it doesn't always have some of those subtle nuances. Now, we've been talking about this trend zone, trend zone, trend zone. We've talked about many of the bullish indicators and things that we've been looking at. And, this zone, it's in a place where it's either going to hold or it's going to break. And it appears to me that the signs are looking like they are pressuring to break. Now, there is a chart pattern that we can talk about a little bit that I would say is an alligator pattern, and it's where it opens up. And something that I've seen occur in the markets more commonly as of late is a pattern like this. And let me see if I can grab a drawing board real quick here and explain how this pattern works. It's something I learned from one of my mentors, and it's a pattern that has really emerged more in the last couple of years in the market, that we refer to and call it an alligator pattern, or engulfing ranges. And, when I first started trading, the markets were a little bit better behaved. They had fewer automated trading systems. And a lot of the things that I learned in textbooks were applied relatively well. And if we were to look at a stock trending up and doing the textbook trend scenario, we kind of look at how it makes higher highs and higher lows. And we look at a textbook pattern like a bullish retracement, where we see the market establish, some strong new highs and come down into what we would expect to be the trend zone or the buy zone, the support resistance zone. And we watch for that signal candle, maybe a doji, a hammer, a harami. It really doesn't matter which one we get. But that's the general setup. And if we were to look at this particular setup in here under the microscope, what we would see in here would be like downward candlestick. We'll go with some downward candles like that. We'd see downward candlestick. Usually they start out pretty hard, and we see them kind of increase, and then we'll see them slow down a bit and shrink a little bit, and we'll watch for those to usually get a little bit smaller, and then maybe you end up with a doji, or let's say you get a little hammer candle or something like that down near where we would expect support to form. And that retracement, as it comes down to that ballpark, what we really love to see is, you know, maybe a white signal candle of some sort, a spinning top, or a little buy signal. And if we were to take that bullish retracement, which would be, you know, the candlesticks that we would see here in my general scribble, what we would then see if we looked at this under the microscope is if we changed time frames and went down into an intraday time frame, maybe 15, 30 minutes, an hour, or something like that, what we now see is a slowing momentum dropping downtrend pattern of day traders. And what we are watching is the slowing momentum, and we're looking for the W's and the inverted head and shoulders. And in this case, you might get an inverted head and shoulder, and we're looking for the breakout and that retracement and reversal. So when we talk about buying above signal candle highs, what we're really talking about is buying above pivot points intraday, buying when a trend violates. Just like I said, the S&P needed to come down and it needed to trade above that W. It had to reverse in order to give us the signal of confirmation of change in trend, and that didn't occur. Now, what the alligator pattern, and this has been really a pretty textbook pattern that we would see in the market, where the markets would drop, they would come down into the support zone or the buy zone, and they'd do a real nice slowing momentum pattern, and they'd form a pretty clean pattern, and then they would break out and they would run like this. What has happened with the advent of more automated trading systems is that those programmers have developed algorithms and ways to kind of take advantage of these classic trading systems. And what we'll see is with that exact same scenario, where we have the uptrend and we are coming down into that buy zone, and again we're looking at those that in the, you know, the under the microscope, we're looking at the candlesticks coming down. You know, they come down for a few days, maybe 3 days, maybe 5 days, maybe somewhere in that ballpark, and we start to see them shrink. And then we start to see what we would hope to see would be like a doji or maybe a harami of some sorts. We see a small body candle in here. And what instead of getting a nice clean, you know, takeoff, which you do get a lot of times, what we end up getting is a confirmation pop up, and then we get hit with a, you know, whipsaw candle right back down, boom, and it ends up hitting people's stop losses, and then maybe it hammers, you know, gaps and hammers, something like this, and, you know, you get some kind of weird little whipsaw of sorts, and you will see, you know, maybe you're bullish engulfing through here, and then it takes off, and you get a little bit messier bottom. And if you look at that underneath the microscope and drop down a time frame, so again, this would be like a daily time frame, and it could be a weekly time frame, and then, you know, we would be looking at the candlesticks dropping down, and so this is our daily time frame. And anytime you drop down a time frame, you're getting a little bit bigger picture of understanding what those traders in that time frame are doing. And what we see in this is you see kind of engulfing ranges, and a better way of thinking about that is like a doji, you know, they say is balance and supply and demand balance. You get really clean shifts, and we love that because the risk is so small. But what we see in this alligator pattern is we see that price, and if this would be an intraday time frame, maybe we'll say that this is 30 minutes. And instead of candlesticks, we're looking at intraday downtrend, and we're seeing it come down. We'll see the slowing momentum into the buy zone, and then as it gets in here and gets ready to trigger, it'll pop up, trigger buyers, rip down, clear stop losses, and then come up, boom, and then you know do these kind of random takeoffs like that. And this is where we get what we refer to as the alligator pattern, and the alligator opens its mouth in this volatile shift. And then just to kind of make sure you guys really see what I'm talking about with the alligator here, let's go ahead and give the alligator here some googly eyes so you guys can picture the alligator really well. And we'll come out here and we'll, you know, give the alligator some nostrils so we can really picture this little gator here. Now, when you watch the Discovery Channel and you see a gator or a crocodile open its mouth and snap down on its prey, because they have those little tiny arms, they don't have the ability to tear the flesh from whatever their prey is. So they roll, and they call that the death roll, when the crocodile goes in the death roll. And so when we see these alligator patterns open up, And what we have to watch for is that whipsaw reversal, that snap, and we'll see whatever the downward trend was run up. And so we see these volatile shifts, and I think it's just the way of the automated trading systems doing a little shuck, then a jive, and it clears out the classic trading strategy. So as I've taught these courses on technical analysis and taught people how to put in triggers and targets and stop losses over the last 10 years, I've had to adapt and change my methods with retracements to use slightly looser stop losses. And this is true on tops as well. You'll see the markets run up, and where you might typically see like a clean little M for murder, you get this boom, 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 boom. And it seems really, really volatile. And it's really more of a fist fight, like I explained. Well, this is kind of what creates, if you stop and think about it for a minute, if, for example, in here we had a down candle in here, and then the next session we see an up candle from say here. This is kind of where bearish and bullish engulfing patterns really kind of get their name, is from that volatile shift. Now we will see chart patterns change directions, and there's really 96 possible variables on how a chart can change trends and directions. But I've boiled it down to about 16 core patterns, and sometimes we'll see those classic M's, or sometimes we'll see consolidations in here, and this is where you get haramis, is where we see those candlesticks will actually form. Here we might have a bullish candlestick that intraday, if you look at it, the next candle that comes inside might have that bearish look, and that would be intraday harami. So as we go in and look at some of our chart patterns, and I see this boom, 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 I'm not automatically sold that the bears are going to run. Now, of course, we've seen some of those signs. We've talked about the economics. We've talked about Japan, and we've put out the things that are telling us about what's going on in Eurozone, that we're seeing slowdown and recession. And the questions now coming down to is, how are the U.S. markets responding? How are the traders responding? And they've put up a fight. We've seen the bulls take a stab at it, but they have not had sufficient follow through to clear that out. And this could be a continuation pattern to the downside. We could see it violate. Let's take a quick look at the other indices. Let's look at the Dow. Let's look at the YM space #F. This is your Dow Jones, and that's got the same type of boom, boom, boom volatile shift. And here's an example of a volatile shift right here, back in here. You might not see it so cleanly, but here is our volatile shift. Boom. And if you literally got triggered in on something like this, where you got stopped out and then it runs on to victory without you, up in here is the opposite, where you get that inside consolidation. And here's where you get more of your clean textbook type pattern out here. So we get all kinds of shifts. There's your textbook dojis. Boy, we love them when we get those. Here's the inside consolidation in here. We can go back and look back. Here's some of the engulfing patterns. This is the engulfing, alligator pattern. And a textbook entry might have gotten you triggered in on this candlestick right in here, but then you got stopped out here, and then it ripped on to victory without you. So sometimes we see those different variations. So now on the Dow, let me clean up all these lines. And I hope you guys don't mind me taking a little time and going into depth on this little chart lesson. Help you understand. We're still in trend zone for the Dow. It still could hold. Same thing with the S&P. I'm not going to be surprised if it breaks, so we'll keep our bull list. And then we will actually look for some bear candidates tonight as well, and I'll throw out some bear candidates. Let's take a look at the Nasdaq and Q. And the Nasdaq is still holding the support zone ballpark. It still has higher low. It did confirm above that a little bit. Let's go. We'll come back and look at the Nasdaq on the ETF. And then before we do that, let's take a quick look at the Russell TF space #F. And boy, we see it really breaking that support zone. Next support zone, it's trading in already. It is definitely giving us that bearish engulfing, maybe double bottom in here. So keep an eye on these, and if we see a break to the downside, we could see a pretty volatile reaction by the market, and it could be a great day for bearish activity. So we'll find some good bear candidates, and you might be able to cash in big on directional trading. Now, of course, not all of our strategies are based off of direction. We have a lot of theta strategies and vega strategies that are less reliable on directional trading. They don't need that as much. But boy, we sure do love it when we can, pull them off. So maybe we look at the IWM for a good one of our first bear picks. We'll go ahead and throw that on the list. Clearing down and breaking support. In effect, we've got big down movement, heavy volume, and a real simple trade would be to put in a sell stop below the candle low, buy stop, trailing buy stop, using a minimum and ATR as a gauge to help you pick out where to place your trail stop or buy stop. So sell stop to get in, buy stop to get out. You can do it with options. With the ETFs, you get some pretty liquid options. Love the Russell, great trading instrument. Let's take a look at that Nasdaq intraday. So let's look at the QQQ. And I wanted to get a look. I don't think I have the total data for some reason here. Let's go. Sometimes with my data provider, we won't always get. There's our downward data. Now if I pop back out to the daily, it might have that. Okay, boom. So here, that double bottom actually is held so far. And we see that double bottom. As we dropped it down into the intraday, I'll hit 30 minutes. And we see where it actually did barely poke, but it didn't close above that W. So here's our W pattern, and it came up and tested it. And so I would dare say it did violate the downward trend, but it did not break the pivot. The pivot's more important than the trend line. It is potentially holding a higher low, but of course we'll see how that goes. Now, I'll go ahead and wrap this video up so I don't keep you here for countless hours before I go put up our watch list just to give you some stuff to trade. Take a look back at the scouting report, and you still have those great candidates to look at and follow through with. We should do a little quick video on that, update that as well. I'm going to crack open the TOS platform, grab my virtual platform for us to look at here for you, and give me a second to drag that over here, and I'm going to show you some good little adjustments in here in a moment after I do the next video. I'm going to go grab a chart, and one of my picks, Twitter's Rockstar, rocking and moving up. I got an adjustment I'll teach about on the next video. Let's take a look at the futures/ES and get in and look at how they are trading in after market activity. Futures, again, trade around the clock. We'd be looking to see if it's continuing to move down. You'd get a gap on the spider, but you'll get a continuous chart on the futures, ES and whatnot. And I'll tell you what, that latest TOS upgrade has been killing me. It is such a memory hog pig, so slow. I think they're trying to kill us. Not sure what they're going for here. Okay, here got my little spinning wheel of death still, but we got the data up. We see this little tiny candle out here after today's session. So you get the big down candle that we all see, and that little tiny white candle, well, that's in fact partial data we're seeing from the overnight session. So as we drop in to an intraday time frame, let me go ahead and do that and pop into our intraday time frame. And here I've got a 30-minute time frame. It actually broke down below the low. It's broken that double bottom, and it's since been rallying up a bit after the close. Kind of a bear retracement. Wouldn't overthink it. Just keep an eye on it as we head into the open. I would dare say in this case we're almost kind of hanging out in what I might even refer to as the bottom of a little trend channel. If we were not to, let me go grab a little trend study here and grab a trend line. I'm telling you, they're killing me with this speed, and I got plenty of memory, and I'm gonna write their programmers, send them a strongly worded letter. Let's grab a trend line, and just kind of talk about what I'm talking about here is ballpark trend angle. And if we were to start drawing our trend line here, shave a few pivots, but I'm kind of getting the general ballpark of it's still kind of in that general downtrend area. And on the big picture, it's still in that possible buy zone. It's pressuring it, though. So if it breaks, all bets are off. What I'd really be watching out for here is, let me grab a new picture here and kind of scribble out what we're talking about here. So what we have is the market on the primary time frame has got like the channel. It's the uptrend, and it's slowing down. It's kind of coming in here, and it's really kind of pressuring that buy zone. So we're watching this for a break, and if it breaks, we can usually see a pretty healthy drop. And in the daily time frame, we're looking at it as candles, and we have those candlesticks that are giving us the bottoms. Intraday, what we're seeing is it came in and it put in our W, failed to take out the new high, and it's in here, boom, kind of pressuring down. So as far as like trend channel goes, it's still in the trend channel here, and it's still flirting in here just a little. Sometimes you'll see these little zones kind of break a little bit and then take off again. So we're watching, what I'd be watching for really right now is where it's kind of come down and it's rallying up a bit, is bear retracement. We're looking for that down for the upside, lower high, and violation to the down to give me a signal to go bearish. So if I see the S&P making that intraday bear retracement heading south, that's going to be my signal. If we see it, rally, put in higher lows, I'm going to require it to violate a minimum of trend line and look for intraday pivots to give us that full reversal signal. And just kind of looking at the the Nasdaq here, it's got the higher low, but looking at like the spider SPY, it hasn't quite shown that, so you might get this with a gap, and then it fills the gap. So we'd be watching for basically, if we get a breakdown, a bear retracement pattern, and it really can bear across this downtrend zone. And violation, we're maybe seeing this is an inverted cup and handle and or a descending triangle. So that ought to give you some stuff to look at technically to help you understand what we're going into with that open. One last thought before we go is let's check the VIX. And the VIX should be shooting up, which is never, some people call the VIX a predictive indicator. I really just think it's a reactive indicator. It doesn't really tell me anything other than the fact that I know the market headed down south. And we see the VIX creeping up, and so we know people are getting scared. And, when I see that, the old saying in the markets, when the VIX is high, it's time to buy, but that's always relative. And just to clarify that, one of the things I like to do is take the VIX and add a Bollinger Band to it, and take the Bollinger Band and use your typical standard deviation. I like to pull the basis line out and put that on there, standard deviation of 2. Then I will throw on a second Bollinger Band I'll change the color scheme on it just to differentiate it for myself. So I'll say, okay, let's set the second one out here to red, and let's change the deviation from 2 to 3. So I'm looking for 3 deviations in price, and I'll eliminate that baseline as well. And what I'd be looking for is that catch of the peak, boom, when it pokes out, boom. But really, we want to make sure we're checking for the failure, to make new highs. If you really hit it when the VIX is high, you may catch market lows, and I look for it to touch that third rail of that third deviation. And then I watch for the reversal signal here, and I watch for the confirmation signal on the S&P. And so we're really not quite out to that third rail here from a daily perspective. If you look at this from a big weekly perspective, however, it's poking out, but it can go much higher. And when the market melts down, the VIX goes higher. So don't make the assumption that this is the high level for the VIX. Once upon a time, they believed that 40 was the high level for the VIX until the meltdown of 2007 and 8, and the VIX went higher than we even knew capable. Not one book ever in trading talked about the VIX at 80 and 90. That was unheard of. So just keep that in mind. The VIX really more of a lag. I think it's not a predictive indicator. It really just tells me that the market's getting skittish, a little nervous, and so we're seeing volatility creep up on the options. It's almost always mirror opposite the S&P. I think it has the potential to go higher, especially if the market breaks down. So don't get suckered into a buy unless we get good confirmation. And one of the things I like to look for if we do get confirmation is just like we see here. This is a really good example of it, where it pokes out and hits that third rail out here, that third deviation, then puts in a lower high, a divergence. And what you'll end up seeing on the S&P, when I'll put in the S&P index on this, and you'll see the exact opposite down here, where it touched the third rail, and we saw the slowing momentum and in the buy zone, and that's where we got that really nice rally. The slowing momentum, the VIX giving a softer reading, was a pretty good solid sign for us. All right, I think I have put together a pretty rock solid video here at tackletrading.com. This is Noah Davidson, Coach D. We look forward to seeing you again participating in the clubhouse. Keep an eye out for the blog, and I'll be putting out as many video updates as I can find the time to do for you. Appreciate y'all. See you online.
Get in the game. www.tackletrading.com